right, welcome to The Explainer. Today, we're jumping into the history of financial analysis to really get to know a classic chart pattern, one that traders have been watching for almost 100 years, the ascending triangle. There's this great quote from Richard W. Schumacher, who was one of the absolute giants of market analysis back in the day. He said, "The market writes its own forecast." And that just captures such a powerful idea, right? That inside all those daily price wiggles, the market is actually telling us a story about where it's probably headed next.
But that's the big question, isn't it? How do you actually learn to read that story? How do you take those chaotic-looking squiggles on a chart and turn them into something that makes sense? Well, that's exactly what we're here to do today. To get our answer, we have to go back to the man himself, Richard Schumacher. People often call him the father of technical analysis, and for good reason. This guy was a real pioneer. He had this core belief that all the seemingly random noise in the market wasn't random at all. He argued it was all driven by human psychology, our collective hopes, our fears, and that this psychology creates recognizable and, more importantly, repeatable patterns. So what Schabacher did, which was pretty brilliant, was organize these patterns into families based on their shape and what they might be telling us. And for this explainer, we're going to focus on one of the most famous and powerful families in his whole system, the triangles. And this is where it gets really interesting. You can see how we broke down this whole family. You've got the symmetrical triangle, which basically shows a market in a state of pure indecision. Then there's the descending triangle, which signals that sellers are getting the upper hand. And then you have our main subject for today, the ascending triangle, which tells a very clear story about buyers getting stronger and stronger. Okay, so let's zero in on the hero of today's explainer. The ascending triangle is widely seen as one of the most reliable bullish patterns out there, and really understanding its structure is the key to seeing what it's trying to tell us. So here's the classic definition, pretty much straight from the source. Think of it like this. It's a picture of a battle where the buyers are slowly but surely gaining ground. You have this flat ceiling holding the price down, but the floor is rising, squeezing everything into a tighter and tighter space. Okay, let's break this down. The pattern is built from two really simple parts. First, you've got that horizontal resistance line. I want you to picture this as a wall, a price ceiling, where sellers are all lined up basically saying, nope, the price is not getting past here. And second, you have the rising support line. This is the floor. It's where the buyers keep showing up. But here's the key. Each time they step in, it's at a slightly higher price than the last time. And it's so important to remember, this isn't just about geometry on a screen. Schabacher saw these patterns as visual stories, a tense drama playing out between supply and demand, between the buyers and the sellers. Now, this whole story kicks off with the buyers. They're getting more eager, a little more aggressive. See, they're not waiting for the price to fall all the way back down to its old low. They're jumping in sooner, and that's what creates that series of higher lows. It's the foundation of that rising bottom line. But on the other side of the trade, you've got the sellers, and they are holding their ground. At one specific price point, they just keep showing up to sell, and that's what forms that flat, horizontal top line. They are creating that stubborn wall of resistance. And this, right here, is the core conflict. You have this rising aggressive force, the buyers, crashing again and again into this fixed, immovable object, the sellers. The trading range gets tighter and tighter. You can just feel the pressure building. I mean, logically, this can't go on forever. When you have a rising floor and a flat ceiling, you're eventually going to run out of room. Something has to give. The question is, who wins? Well, Scheinbacher's research pointed to a pretty clear answer. So let's see how this story actually plays out. And this is the fun part. We're going to look at some of the real, actual charts that Schabacher himself was analyzing way back in the 1930s. Okay, your turn. Here is a chart of Hudson Motors from 1933. Just take a close look at the price action. Based on everything we've just talked about, can you see that story of building pressure? Can you spot the triangles starting to form? And boom, there it is, a textbook ascending triangle. The buyers just kept pushing from higher and higher levels until they finally soaked up all the shares the sellers were offering at that resistance line. And once those sellers were cleared out, the price broke out and it moved decisively up, just like the theory predicted. It's a beautiful example.
Let's do one more just to really lock this in. This is Johns Manville from 1936. Can you see the exact same battle playing out here? Look for that rising floor of buyers running into that flat ceiling of sellers. And you can see it so clearly. That rising support line shows you the determined buyers. The flat resistance line shows you the stubborn sellers. The price gets squeezed, the pressure builds, and then breakout. The buyers finally overwhelm the sellers, and the price shoots higher. The pattern nailed it. Again. Okay, so these patterns clearly worked in the markets of the 1930s. But that brings us to the million-dollar question, right? How relevant is a signal that's almost 100 years old in today's world? And this really gets to the absolute heart of Schumacher's whole theory. He never thought these patterns were some kind of magic. As he said himself, they were simply pictures of our collective psychology, the result of thousands of different people all acting on their own hopes and fears. The patterns are just a reflection of us. Which leaves us with a really fascinating final thought to chew on. I mean, Schwabacher was analyzing markets driven by people reading newspapers and literally shouting orders on a trading floor. Today, our markets are dominated by light-speed algorithms and high-frequency trading. So the question I want to leave you with is this. Does that fundamental human psychology that creates a pattern like the ascending triangle still drive the market, or have the machines changed the story for good? That's something to think about.